Instruments of monetary policy used by the RBI. Direct regulation, cash reserve ratio (CRR). Commercial banks are required to hold a certain proportion of their deposits in the form of cash with RBI. CRR is the minimum amount of cash that commercial banks have to keep with the RBI at any given point in time. RBI uses CRR either to drain excess liquidity from the economy or to release additional funds needed for the growth of the economy. For example, if the RBI reduces the CRR from 5% to 4%, it means that commercial banks will now have to keep a lesser proportion of their total deposits with the RBI, making more money available for the business. Similarly, if RBI decides to increase the CRR, the amount available with the banks goes down. Statutory liquidity ratio (SLR). SLR is the amount that commercial banks are required to maintain in the form of gold or government-approved securities before providing credit to the customers. SLR is stated in terms of a percentage of total deposits available with a commercial bank and is determined and maintained by the RBI in order to control the expansion of bank credit. For example, currently, commercial banks have to keep gold or government-approved securities of a value equal to 23% of their total deposits. Indirect regulation, repo rate. The rate at which the RBI is willing to lend to commercial banks is called repo rate. Whenever commercial banks have any shortage of funds, they can borrow from the RBI against securities. If the RBI increases the repo rate, it makes borrowing expensive for commercial banks and vice versa. As a tool to control inflation, RBI increases the repo rate, making it more expensive for the banks to borrow from the RBI with a view to restrict the availability of money. The RBI will do the exact opposite in a deflationary environment when it wants to encourage growth. Reverse repo rate. The rate at which the RBI is willing to borrow from the commercial banks is called reverse repo rate. If the RBI increases the reverse repo rate, it means that the RBI is willing to offer a lucrative interest rate to commercial banks to park their money with the RBI. This results in a reduction in the amount of money available for the bank's customers, as banks prefer to park their money with the RBI as it involves higher safety. This naturally leads to a higher rate of interest, which the banks will demand from their customers for lending money to them. The RBI issues annual and quarterly policy review statements that control the availability and the supply of money in the economy. The repo rate has traditionally been a key instrument of monetary policy used by the RBI to fight inflation and to stimulate growth. What is a DeMat account? DeMat is nothing but a dematerialized account. If one has to save money, similarly, one needs to open a DeMat account if he/she wants to buy or sell stocks. Thus, DeMat account is similar to a bank account wherein the actual money is being replaced by shares. In order to open a DeMat account, one needs to approach the depository participants. In India, a DeMat account is a type of banking account that dematerializes paper-based physical stock shares. The DeMat account is used to avoid holding of physical shares. The shares are bought as well as sold through a stockbroker. In this case, the advantage is that one does not need any physical evidence for possessing these shares. All the things are taken care of by the DPS. This account is very popular in India. Physically only 500 shares can be traded as per the provision given by SEBI. From April 2006, it has become mandatory for any person holding a DeMat account to possess a permanent account number (PAN). Basel Committee. The Basel Committee on Banking Supervision provides a forum for regular cooperation on banking supervisory matters. Its objective is to enhance understanding of key supervisory issues and improve the quality of banking supervision worldwide. It seeks to do so by exchanging information on national supervisory issues, approaches and techniques, with a view to promoting common understanding. The committee's secretariat is located at the Bank for International Settlements (BIS) in Basel, Switzerland. Need for such norms. The first accord by the name Basel Accord I was established in 1988 and was implemented by 1992. It was the very first attempt to introduce the concept of minimum standards of capital adequacy. Then the second accord by the name Basel Accord II was established in 1999 with a final directive in 2003 for implementation by 2006 as Basel II norms. Unfortunately, India could not fully implement this but is now gearing up under the guidance from the Reserve Bank of India to implement it from the 1st of April, 2009. Basel II norms have been introduced to overcome the drawbacks of Basel I Accord. For Indian banks, it's the need of the hour to buckle up and practice banking business at par with global standards and make the banking system in India more reliable, transparent and safe. These norms are necessary since India is and will witness increased capital flows from foreign countries and there is increasing cross-border economic and financial transactions. Features of Basel II norms. Basel II norms are considered as the reformed and refined form of Basel I Accord. The Basel II norms primarily stress on three factors, viz. Capital adequacy, supervisory review and market discipline. The Basel Committee calls these factors as the three pillars to manage risks. Basel III. The Reserve Bank released guidelines outlining proposed implementation of Basel III capital regulation in India. These guidelines are in response to the comprehensive reform package entitled Basel III. A global regulatory framework for more resilient banks and banking systems of the Basel Committee on Banking Supervision (BCBS), issued in December 2010. Know your customer. The Reserve Bank of India (RBI) has advised banks to follow KIC guidelines, wherein certain personal information of the account opening prospect or the customer is obtained. The objective of doing so is to enable the bank to have positive identification of its customers. This is also in the interest of customers to safeguard their hard-earned money. The KIC guidelines of RBI mandate banks to collect three proofs from their customers. They are photograph, proof of identity, proof of address. SWIFT. The Society for Worldwide Interbank Financial Telecommunication (SWIFT) operates a worldwide financial messaging network which exchanges messages between banks and other financial institutions. SWIFT also markets software and services to financial institutions. Much of it for use on the SWIFT-NET network, and ISO 9362 Bank Identifier Codes (BICs) are popularly known as SWIFT codes. Instruments of money market. 1. Call money. Call or notice money is an amount borrowed or lent on demand for a very short period. If the period is greater than 1 day and up to 14 days, it is called notice money. If the period is greater than 1 day and up to 14 days, it is called notice money. Otherwise, the amount is known as call money. No collateral security is needed to cover these transactions. The call market enables the banks and institutions to even out their day-to-day deficits and surpluses of money. Cooperative banks, commercial banks and primary dealers are allowed to borrow and lend in this market for adjusting their cash reserve requirements. This is a completely interbank market. Interest rates are market determined. In view of the short tenure of these transactions, Both borrowers and lenders are required to have current accounts with Reserve Bank of India. 2. Treasury bills. Treasury bills are the shortest-term Treasury securities, those that mature within a year. The Treasury issues 3- and 6-month bills weekly and a 1-year bill once a month. Treasury bills are discount instruments. Rather than making interest payments, they are issued at a discount to face value and mature at face value. The interest rate is a function of the purchase price, the face value and the time remaining till maturity.